Gulf sovereign wealth funds currently control approximately $6 trillion. It is a massive pool of capital built over years of record-breaking oil and gas revenues. Since 2021, these funds pivoted. Their allocation in high-risk global assets jumped from 17% in 2007 to 44%, moving away from U.S. Treasuries. This outward flow is staggering. For every energy dollar earned, 75 cents goes into foreign markets, supporting global tech and sports. This global investment cycle was disrupted in February 2026, when the outbreak of the U.S. Israeli war on Iran immediately destabilized the Middle East. The conflict has stalled energy production and compromised critical shipping lanes. With tourism and aviation also taking a hit, the Gulf states are seeing a rapid decline in the very revenues that fuel their investment funds. At the same time, the necessity of a massive increase in domestic defense spending is draining available cash at home. Facing these rising domestic costs and falling revenues, Gulf officials have begun internal reviews to activate force majeure clauses in existing contracts. To preserve their own economies, they are preparing to halt the flow of capital to the outside world. The global market now faces an indefinite freeze on future investment commitments, as these states redirect every available dollar toward their own borders. This shift is causing immediate concern in Washington. The Trump administration is currently tracking the potential collapse of over $2 trillion in previously announced Gulf investment deals. U.S. officials have received warnings that Gulf states are only weeks away from repatriating tens of billions of dollars. Withdrawing that much liquidity would directly conflict with the president's domestic investment agenda. On Wall Street, the focus has shifted to the 2026 mega IPOs, which are now at risk of losing their primary financial support. Companies like OpenAI counted on sovereign funds from Saudi Arabia, the UAE, and Qatar to act as anchor investors. Without that backing, the path to a public offering is no longer certain. SpaceX faces a similar challenge. The anticipated largest IPO in market history was built on the assumption of Middle Eastern capital that is now being pulled back. The message to Wall Street is now becoming clear. The primary pipeline for sovereign capital has effectively closed. The withdrawal of Gulf funds reaches past the technology sector and threatens the ability of developed nations to fund their own government operations. This chart illustrates the dependency. Western nations rely on Gulf funds to purchase their national debt. Without these massive buyers in the market, the cost of borrowing rises, forcing national interest rates higher. Following the chart downward, we see the impact on developing nations. As global borrowing costs rise, these smaller economies are priced out of the market, losing the ability to fund their own growth and stability. This debt crisis is arriving alongside a historic energy shortage and the breakdown of supply chains, further straining national budgets worldwide. Economist Mohammed El-Arian notes that while the Gulf region has historically shown a remarkable ability to adapt and recover from such shocks, the immediate impact on global markets will be felt by every household in affected economies. For the West, the pullback is a reminder of how deeply its economic stability depends on a constant influx of foreign capital. If the conflict in 2026 permanently alters the financial partnership between the West and the Gulf, it creates an opportunity for a new global power to intervene. If China moves in to fill that massive void, becoming the primary security and economic partner for the Gulf, the 2026 conflict may mark the end of the West's financial leverage in the region. In late May 2008, the U.S. economy was fracturing under the weight of the subprime mortgage crisis. Financial institutions were collapsing, and Treasury Secretary Henry Paulson needed cash, fast. He boarded a plane for a rapid-fire tour of the Middle East, landing in Jeddah, Abu Dhabi, and Doha. This graph tracks the global price of crude oil, showing a massive spike toward the end of the 2000s. While Washington was bleeding, the Gulf was experiencing a historic windfall. By the spring of 2008, a barrel of oil was approaching $100. For the 6 Gulf Arab states, that translated into a combined daily profit of $1.5 billion. Paulson met with regional leaders, including King Abdullah of Saudi Arabia, and made a highly specific pitch. The United States wanted the Gulf to take those massive, newly minted oil profits and inject them directly into bleeding American financial markets to help stabilize the crisis. It worked. In January 2008, Kuwait's sovereign wealth fund poured $3 billion into preferred shares of Citigroup, a bank that was hemorrhaging billions. It was a massive risk, but less than a year later, Kuwait converted and sold those shares for $4.1 billion, securing a 37% return. This 2008 bailout exposed the mechanics of a financial dependency that had anchored the American economy for over 30 years. It was a multi-trillion-dollar arrangement that Washington grew to rely on, and it is quietly coming to an end. To understand how this reliance formed, we have to look back to a confusing moment in 2005. Testifying before the Senate, Federal Reserve Chairman Alan Greenspan admitted to lawmakers that he was completely baffled by a market anomaly. He simply referred to it as a conundrum. Here is a chart showing exactly what was confusing him. At the time, the Federal Reserve was aggressively raising short-term interest rates. Typically, when a central bank does this, the yield, or the interest paid out, on long-term government debt goes up too. But as you can see, the exact opposite was happening. The Fed raised short-term rates by 150 basis points, yet the yields on long-term U.S. Treasury bonds kept dropping. A month later, Ben Bernanke, then a Fed governor, provided the answer. He called it the global savings glut. He realized that massive pools of foreign capital, specifically from Asian manufacturing hubs and Middle Eastern oil exporters, were pouring into the U.S. debt market. Traditional economic models hadn't broken. Instead, the United States bond market had become so heavily saturated with foreign wealth looking for a safe harbor that domestic monetary policy was being overridden by international demand. During this period, the Gulf states operated under a highly conservative investment strategy. As oil prices skyrocketed, they took the bulk of their windfall and parked it in what is widely considered the safest asset on Earth, long-term United States government debt. This created a very specific mechanical reaction in the market. As hundreds of billions of petrodollars chased after these bonds, the massive demand drove the bond prices up. Because bond prices and bond yields move in opposite directions, the immense buying pressure automatically forced the yield down. We can actually measure the impact of this demand. Between 2005 and 2023, the sheer volume of Gulf oil revenue entering the U.S. market artificially depressed the yields on American treasuries by an estimated 25 basis points. 0.25% might sound small, but applied across the national debt over nearly 2 decades, it meant the U.S. government didn't have to pay out as much interest to its creditors. That foreign demand saved American taxpayers roughly $700 billion. It was a highly efficient, multi-trillion-dollar symbiosis. The Gulf nations secured a perfectly safe, reliable vault to store their cash, and in return, the United States received a massive, continuous discount on funding its own debt. But that relationship is fracturing. This chart compares the top foreign holders of U.S. debt today. A country like Japan currently holds about 13% of all foreign-owned U.S. treasuries. The Gulf states combined now hold only about 2 to 3%. They stopped buying. The shift is driven by an existential timeline. Gulf leadership recognizes that the era of peak oil demand will eventually end. When that happens, the low, steady returns offered by American government bonds will not generate enough income to keep their economies running. To prepare, they are adopting what economists call the Norwegian model. Instead of passively lending their surpluses to the United States, they are routing their capital through roughly 11 different sovereign wealth funds. These funds operate aggressively on the global market, prioritizing high-risk, high-reward investments over safety. They are also pulling that money inward to finance their own domestic transitions. Saudi Arabia, for instance, is leveraging an estimated $2 trillion to fund Vision 2030, a massive state initiative designed to build entirely new, non-oil industries from the ground up. The incentive structure has inverted. The Gulf can no longer afford the luxury of letting its wealth sit quietly in American financial vaults. Every dollar is now required at home to secure their own post-oil future. For Washington, the timing is difficult. Just as the United States is rapidly expanding its national debt, the Treasury is losing one of its most reliable, price-insensitive buyers. Without the constant, artificial suppression of interest rates provided by decades of petrodollars, the baseline cost of borrowing for the American government will drift higher. While the Gulf holds a smaller percentage of debt than Japan, their role as consistent, price-insensitive buyers acted as a subsidy for the American taxpayer. Their departure removes that financial floor, leaving Washington to find a new way to bridge a multi-trillion-dollar deficit in a world that is no longer willing to fund it at a discount.